What's going on, guys? I'm Arkham and welcome back to my channel, and in this video I'm going to show you how I'm able to make multiple six figures a year being a 19-year-old day trader. If you guys have been following me for over a while, you guys know that I have over 90,000 plus followers across all social media platforms, and the only thing that I post is just raw, boring, and educational content. Right? There's no Lamborghinis, there's no watches, there's no houses. The only thing that I give on these channels is just straight value. Right? If your goal is to become a full-time trader, or the goal is to become a better trader, these are the type of videos that you need to watch, because in these videos I not only talk about strategy, but I also go over the different components not a lot of people talk about that's very important when it comes to becoming a full-time trader. Things like overall psychology, things like risk management, trade management, as well as detachment from losses, as well as the thousands of gems and nuggets that I give out throughout this entire YouTube channel. If you guys are passionate about trading and want to become a full-time trader and be in my position, which it doesn't have to take long, make sure you guys watch till the end of this video and take notes and get a lot of value from it. Just a quick background over me: I've been trading for a little over 2.5 years now, and the last 2 years I've dedicated most of my time and energy to mastering ICT concepts. Some of the concepts that you've probably heard, like rejection blocks, candlestick anatomy, open, high, low, and close, daily bias, order block theory, as well as turtle soups, so essentially have all been taught for me and simplified by me. So if you're someone who's new to my channel and you're looking for a mentor that knows everything about SMC or ICT concepts and that's able to simplify it in a way that even your dog can understand it with precision, you have come to the right channel. Throughout this entire YouTube channel and video, the only thing that you're going to get is just straight education and value to help you become a full-time trader. And I have helped countless students become better traders. Now at a point in my life, what brings me immense joy is helping you guys achieve the same results. So we have students like DS, as well as Tony, as well as countless other students who's been able to get payouts as well as become full-time traders. And throughout the entire year of 2025, me and my brother are creating something special. We're calling it the Spark Movement, which every single day we will be live trading as well as giving education inside the mentorship every single day. The goal of the Spark Movement is to help motivate every single student to get their first payout and make their first $10,000 trading. And if you guys want to be next and join that Spark Movement, you guys can click the first link in the description and join the Spark Trading Mentorship. And throughout this entire video, we're going to be covering a wide array worth of topics. So first, we're going to go over the strategy, things like time frame, structure, POI, daily bias. We'll talk about that later on. Then we're going to be breaking down a $20,000 week, going over the strategy, risk management, psychology, as well as trade management. As well as towards the end of the video, I will be giving you guys a full PDF going over the training plan, as well as a backtesting guide to help you become better traders and achieve similar results. So before we go over the overall strategy, we have to understand how does the market moves, and it moves within these three phases. First, we have the opening phase, then we have the manipulation, and then lastly we have the distribution. Within the opening range, this is very simple. This is where the market simply just opens up. What makes this very important is you guys want to mark out the opening price of that higher time frame candle. So the higher time frame candle can be a daily time frame if you're a swing trader, it could be a 4-hour time frame if you're a day trader, or it could be a 1-hour time frame if you're a scalper. We'll talk about that a little bit more, but first thing we're going to talk about is marking out the opening level of our higher time frame candle. The manipulation phase of the markets is one of the most crucial parts of any market cycle. Like, for the market to go higher, it must first go lower to tap into a level of support to give it that liquidity that it needs to push higher. And for the market to go lower, it must go higher to reach a level of resistance to give it the liquidity that it needs to go lower. Right? The manipulation is simply the fake move to give price the liquidity that it needs to then create the real move. And then last but not least, we have the distribution. The distribution comes after the manipulation phase. Right? This is where price creates that real move. So my main emphasis is, if I'm bullish, I want to be buying below the opening price. I want to see price open up, come lower to find a level of support. So since I'm already bullish on the day and created a day by time bullish, I know that price is coming lower to tap into a level of support, so essentially to then get me into distribution phase. Vice versa, if I was bearish, I'd want to see price open up, it didn't initially go higher to create a fake move higher by tapping into a level of resistance, and then I'd want to see price go lower. This is probably one of the best strategies when it comes to trading the markets, because you not only get a great entry at these lows here, but you also have a amazing risk to reward if you're able to catch the low of the day or the low of your higher time frame candle. And obviously we have our higher time frame candle to our right here. So if I was a swing trader, this higher time frame candle would be the daily, and I'd most likely be looking at the H1. If I'm a day trader, this would most likely be the H4. I'd be looking at the M30, M15. And if I was a scalper, most likely this would be a H1 candle. and I'd be looking at the M15 or M5. But obviously it's not always as simple as price opens up and comes lower, right? Price has to come lower to somewhere. It has to come lower to a level of support, or maybe come higher to a level of resistance. This gets us into our next lesson, which is our points of interest. And the first point of interest that we want to talk about is the fair value gaps. And the fair value gap is very, very simple. It's a 3 candlestick formation, right? So we have the separation from this first candle's high to this third candle's low, right? If we're in a condition to where the marketplace is bullish, we want to see price open up, come lower into this bullish fair value gap to find support to push higher, right? That's the overall emphasis. So this candle right here, let's say this was a higher time frame candle. Let's say I was a day trader, right? I was a day trader and this was a 4-hour candle. This 4-hour candle opens up and comes lower into this fair value gap. This would be my overall manipulation to capitalize on a buying opportunity to reaching back above higher prices. So this is the overall emphasis. So as the higher time frame candle opens up and comes lower, it has to come lower into a higher time frame level of support. Right? First we have this fair value gap, and then next we have this order block. So from a bearish example, we could see this last up close candle. Right? This last up close candle right here, following it, we had this bearish engulfing candlestick closing right back below it. Right, with strong displacement, right? There needs to be strong displacement and a strong body close, right? Seeing this strong body close below this last up close candle, as the next candle opens up and comes higher within that last up close candle, this is then referred to as that order block. So price comes back within that level, we see that level of resistance, and then we come back lower prices. So let's say we were scalping and this was a 1-hour time frame. We create this last up close candle, price creates this bearish engulfing candlestick, signaling that price is likely to go lower. As this 1-hour candlestick opens up and comes higher, we want to see it come higher into this last up close candle, right? Once price comes back up into this last up close candle, and then we start seeing price reject from it, this would give us the overall confirmation that, okay, this is that manipulation and I can capitalize on a short opportunity. As long as I'm shorting above the opening price of this higher time frame candle, this gives me the highest probability opportunity to get the best entry to reaching back below lower prices. And then last but not least, we have the rejection block. And the rejection block is very simple. It's a long wick level within the markets. So we can see price opened up, came lower, create this long wick within the markets, rejecting back higher prices, right? Usually people won't, really pay this any mind or really even care about it, but it's actually a level of support that we can use, because when price creates this long wick within the market, this is actually an inefficiency, kind of like a fair value gap, right? And we can mark out the different quadrants of this long wick. So we have the 25% of the wick, the 50% of the wick, and then we have the 75% of that wick level. So we can see here this next candlestick opens up, comes back down within the 25 to 50% range, right? Comes down into that 25-50% range, finds that level of support to then obviously push higher. So whenever you identify these long wicks inside the markets, right, these are levels of inefficiencies that price usually comes back into, and always mark out the 25-50% as levels as support or resistance. We're going over the next lesson, which is essentially just putting everything together, going over time frames, specific times, as well as models. As a day trader, my main priority is to focus on the H4 timeframe, preferably the New York session H4 timeframe, right, between 10 a.m. to 2 p.m. EST, right? When you think of a market maker, you have to think from the lens of greed. This may seem harsh or this may seem mean, but this is really how the market works, right? How can we screw over the most traders? The market is going higher. I simply just see it as a manipulation to go higher to eventually go lower, as well as when the market opens up and goes lower. That's also my interpretation that price is just going lower to screw over a lot of traders and fake out a lot of traders before potentially seeing a buying opportunity. Just buy when you see the market go higher or when you see the market go lower, right? You want to anticipate a manipulation to eventually catch that distribution move, right? Price has to open up and come into a higher time frame level of support or resistance or a liquidity pool. Within this case scenario, we have this 4-hour level, right? This first 15-minute candle opens up, comes higher, second 15-minute comes higher again, third 15-minute comes higher to tap into a level of resistance. And this level of resistance can be a H4, H1, or a 15-minute fair value gap, order block, rejection block, or liquidity pool, right? In terms of liquidity pool, this could be previous day highs and lows, prior session highs and lows, and equal highs and lows. So essentially price basically comes up into a level of resistance, it takes out that level of resistance, and then we want to see a break in the opposing direction on the 15 minutes. So within this scenario, we could see price open up, come higher, 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 tap into this level of resistance, and then we see this bearish engulfing candlestick on the 15 minutes. Following this bearish engulfing candlestick, this would then be my confirmation that when price came higher, right, when price came higher into this level of resistance, price had established this high, right? Price established this high, it found the resistance that it needed, it faked out the traders that it needed, and now we're going in the real move. And after again this breaker structure in the opposing direction, I want to be looking for order blocks or fair value gaps on the 15 minutes, which we can see here. Price creates this 15-minute bearish fair value gap. Price comes back within it right here, finds a level of resistance to reach back below lower prices for that distribution. Right, so as the 4-hour time frame opens up, I want to see it open up, come higher into a level of resistance to find the resistance that it needs. And then if we can get a breaker structure in the opposing direction from that resistance level, I can now categorize this as a protected high, meaning price should not break back over this high point, and any fair value gaps or order blocks on the 15 minutes following this breaker structure would then be relevant for my entry for that distribution. It can be said for a bullish scenario if you're more of a scalper. So if I'm a scalper, I'd like to be looking at the 1-hour time frames, right? And I'd want to be trading on the 5 minutes, right? And this is a strategy that I call the 10 to 11 a.m. soup, where I'm anticipating the 1 hour to open up, come lower, create that total soup on the 1 hour to then catch that high. Opposing direction, if price opened up, came higher to tap into a level of resistance to then reach back below lower prices. Same thing, right? I trade during the New York session, right? And for the 10 to 11 a.m. soup, this would be 10 to 11 a.m. or 11 a.m. to 12 p.m. EST. Thing like we said previously, right? We have to think from the lens of a market maker, right? We have to open up and create a manipulation. That manipulation is what creates our liquidity. The liquidity is created from faking out traders. So as the market opens up and goes lower, thousands upon thousands of traders are trying to short the markets, thinking that we're, following the trend. Maybe it was a double top or, whatever retail strategy there was. Price opens up and comes lower. A lot of retail traders are very impulsive. They don't have the discipline to wait and be patient. So most likely as the market's going lower, they're probably chasing it. Those traders are then creating the liquidity that's needed to take the market back higher. So once the market opens up and comes lower to create this manipulation, a lot of traders get faked out. Most of them get stopped out, and that then creates the liquidity that offsets the long positions. Fair value gap, order block, rejection block, or liquidity pool, and we can see this breaker structure to the upside. Once price taps into this level of support here from the 1 hour, 30 minutes, or 15 minutes, and then we start seeing this breaker structure in the opposing direction on the 5 minutes, then we can look for entries on the M5 fair value gaps or M5 order blocks, which we can see this break higher. Price comes back within this 5-minute fair value gap, as well as this last stop close candle right here is the 5-minute bullish order block, right? This last stop close candle following this bullish engulfing candlestick right here. Price comes down into this level, gives this rejection, comes down, gives this rejection again, and then we start seeing price reach back over higher prices. So the overall emphasis is very simple. We want to catch that manipulation move within a level of support resistance to anticipate a reversal for our distribution. If you guys want a copy of today's PDF, training plan, as well as specific times to trade this exact model to help you backtest and become better, I will be putting it inside the PDF section inside of the free Discord community. All you have to do is click the first in the description, join the free Discord community, as well as if you want live trade with us every single day, as well as access to daily education, weekly calls, as well as much more, you guys can click that first in the description and join the Spark Trade mentorship. Just like I mentioned, we are going through the Spark movement, which we will be live trading and educating every single day with the students to help our students get their first payouts and make their first $10,000 trading. If you guys want to be a part of that Spark movement and become a student, you guys can click that first link description and join the Spark Trade mentorship. So for our first example here, we're just looking at the Spark journal, and we're going to go over this trade here taken on March 31st on the S&P 500, which made us a little over $7,200 on the day, right? And this would be the before picture right here, which we can see price entering into our level, and then we could look at the after, which we can see price hitting our full take profit. So we're looking at the S&P 500 here on that same Monday, and we're going to be creating what's called a daily bias. And a daily bias is very, very simple. It's simply identifying where has the market been, where is the market currently at, and where do we anticipate the marketplace to go next. Right, we have to focus on the movements that happened prior to us coming into the markets, create a hypothesis to where we anticipate the marketplace to potentially go next. We're looking at the 4-hour time frames here, right? As a day trader, I'm looking at the 4-hour time frames, right? Sometimes I scalp looking at the 1 hour, but for this first example, we're going to be looking at the 4-hour time frames. Just coming into a New York session here before 10 a.m., I'm simply just marking out potential levels of support and resistance, as well as areas I potentially anticipate the marketplace to come next. And this day in specific was very, very simple, right? So we can see the prior day here from this Friday, we saw this massive drop to the downside. Right? If we know anything about the markets, we have to understand the markets is simply just a series of corrections and expansions. Obviously, see, we had this massive expansion to the downside, reaching back below lower prices. Right? For every expansion move within the markets, price has to create some type of correction. Right? The market cannot just continue going lower and lower and lower forever, right? It has to create some type of correction to gather additional liquidity, so essentially before potentially continuing going lower in that direction or potentially giving a reversal. Within this day, I was simply looking for a potential buying opportunity. We can identify that price came all the way back down here into this last down close candle. Since we do have a large body here, I will be marking out from the body to body. Extended this forward right here, this would be identified as our 4-hour order block. It's a 4-hour level of support that we've seen the marketplace obviously come down into. See, we have the 50% of that order block level, and this is what's called our mean threshold, which is basically a strong level of support. The price comes down into that mean threshold right there and kind of gives this slight rejection to the upside. So we can obviously see that price has come down into a higher time frame level of support. After we've identified our level of support, we want to identify maybe where do we anticipate price to potentially go next. Obviously identified right throughout this entire drop lower, price has created multiple levels of inefficiencies. We can identify this first bearish fair value gap right here. We can identify this second fair value gap all the way back up here. Multiple levels of inefficiencies above us that price has to come back into, right? When price creates these inefficiencies after an expansionary move, price tends to consolidate a little bit before coming back into these inefficiencies, right? It would not make sense for me to continue being bearish. We're at an extreme low level, right? Price is not just going to continue going lower and lower and lower, right? It has to give some type of correction to fill in these inefficiencies as well as to gather liquidity before going lower. Following this massive drop to the downside and coming into the markets, my only bias is bullish prices, right? I'm not looking for bearish prices at all, just because we're at an extreme low level, right? It would not make sense for me to short at these exact lows. You're literally shorting at the lows, right? So seeing a massive expansionary phase like this coming at 10 a.m. hour as that higher time frame candle is about to open up, I want to be buying at or below the open price of the 4-hour candle. Now I'm going to go down to the 15 minutes time frame here, and on the 15 minutes just before 10 a.m. opens up, I want to conclude what has the New York Open done. So the New York opens here at around 9:30. Specifically, I'm trading between that 10 to 2 p.m. hour. 9:30 open up, we come lower and we tap into 50% of that order block like we mentioned, as well as we do see price taking out the level of liquidity below us. On my side here, I have my 4-hour candle. Specific indicator is called the ICT HDF candles by Fadi. Just based upon this analysis alone, I kind of already framed my overall setup. We've come lower into a 4-hour bullish order block. And we can see here that price had give this bullish engulfing candlestick here on the 15 minutes, right? Creating this last down close candle right here. This last down close candle right here. We can see price breaking above it. Price came down into the level of support, and then we had a breaker structure in the opposing direction here on the 15 minutes. I can classify this as a strong low point. This would be what's called a protected low, meaning that if I'm bullish on the day, I'm already anticipating that this low is the low. So as long as I can frame an entry within this level, price should not come back below this low point or even near it. Just keeping things very, very simple. Just identifying my higher time frame levels of support and then utilizing the candlesticks open, high, low, and closes. We opened up, came lower into that level of support. We gave this rejection to the upside, breaking structure. This low is now a structural low that price should not break back below. As the next 15-minute candlestick opens up, so essentially or 10 a.m., I want to see price come back within this last down close candle right here. And specifically on this day, I went down to the 5 minutes. The reason why I went down to 5 minutes time frame is because I've already established the low on the 15 minutes. right? So the 5 minutes, I'm just looking for additional confirmation. Have this first fair value gap right here. We have this fair value gap right here above it. Specifically, when it comes to these conditions where we have multiple fair value gaps, what I like to do is I like to use the most recent fair value gap. It's my entry within this first fair value gap right here, but this is the trick right here. I took my first entry within this first fair value gap. Whenever I take my first trade, I have a wider stop loss. The stop loss was back down here for about 15 points, and this goes over the trade management aspect, right? Whenever I take my first trade within a position, I use a lot less risk, but a wider stop loss, right? Even though I took the trade within this first fair value gap, price could still, come all the way down here and tap into a second fair value gap. So that's why I have that wider stop loss for my first trade, just to take into account any added volatility within the market. Price could easily come down into this first fair value gap and push higher, but it could also come down into the second fair value gap as well and push higher. No one's perfect in terms of identifying where price is going to come down into. Just in case price were to come down here, I have a much wider stop loss. And if price were to come down into this level and see a breaker structure, what I would do is I would scale into my position. So let's say price comes down into the second fair value gap here, and then we start seeing a breaker structure breaking back off these high points. I would then scale into my position and I would adjust my stop loss back below these lows. That first trade has a much wider stop size, just to take into account any added volatility. And then as price goes in my favor, I obviously scale in, target these levels of liquidity above us, right? We have these high points just like so, as well as we do have these fair value gaps up here. All right, so essentially in terms of this day, I was just simply targeting a level of liquidity right here. So we were aiming for about a 2.2R right on this trade. Do anything different this day, I probably would have taken 90% of my position off at these high points, or just left the runner running for, the fair value gap up here and the fair value gap all the way up here, as well as this trade is in alignment with the low of the opening price. So we have that 4-hour candle. We want to see price come down lower, right below the opening price inside of that manipulation to find support to push higher. So overall, this is a very good A+ setup. See how it pans out. Price comes down into that fair value gap, and then we see this immediate break to the upside, right? Once I got this break to the upside right here, right, which we can see price breaking back above this bearish fair value gap inversion, I then scaled into my position. I put my original entry, right, basically back below these lows or break even. Then my new entry right here, just back below this low point. I wait for price to come down into me. I use that low risk but a higher stop size to take into account any volatility. Once price goes in my favor, I then scale into my position here and adjust my stop size, keeping my risk very, very tight. But if price were to go in my favor, I maximize on my overall reward. And we can see price comes lower again, and then eventually goes higher, takes out that level of liquidity, and then continues higher throughout that entire day. At opening, price came in to have 4-hour order block level, got that 15-minute breaker structure to the upside, took this trade off this 5-minute fair value gap, reaching back above levels of liquidity, catching the exact low of day, making me a little over $7,000 on this day. We'll be looking at this other example here taken on April 1st, basically the next day, once again making me a little over $7,200 on the day. And this was the exact setup right here. We could see the before, where we were inside of the trade idea, and then we can see after, right? This was a very good trade, right? Both Monday and Tuesday were very good days. Basically call these trades every single morning within the Spark trading group, and this week was very, very profitable, making a little over $20,000, right? So essentially now I'm gonna go on to the charts and break down this trade just like I did before. The charts here, right, looking at the 4-hour time frame, just keeping things pretty simply. Coming into the next day, we're just simply creating our daily buys, right? What has the market done the prior day, or so essentially what has the market done prior, and so essentially where are we currently at, and where do we anticipate the market to potentially go next. We can identify these previous day highs right here, right? These previous day highs are levels of liquidity. Day highs and lows, they're levels of liquidity within the markets. If we were to be bullish on the day, most likely price would take out this level. So on the 4-hour time frame, nothing else really, nothing too crazy. We can kind of take note of like this 4-hour fair value gap, but we could see price kind of already mitigated it a little bit, right? Where price kind of already tapped into it and pushed higher, right? Nothing else too crazy on the 4-hour. We do have this 4-hour bullish fair value gap below us. We'll take note of that as well. Yeah, so we have this level of liquidity. We have these 2 fair value gaps here. Nothing really too crazy on the 4-hour. Let's go down to 1-hour time frames. On the 1-hour time frames, we get a little bit more information right here, right? When created day buys, you basically want to go through the time frames. You want to gather additional information. You want to create a hypothesis of what to anticipate to happen. So on the 1-hour, we can already see here the prior day came lower, took out a level of liquidity, just like we talked about. And then we had a 1-hour breaker structure to the upside. Okay, we had a breaker structure to the upside, taking out a level of liquidity. and now we're back above these high points. Have these levels of liquidity above us, which was these prior day highs. It's super solid, right? We came lower down into a level of support, right? Price took out level of liquidity. Following that level of liquidity, we had a breaker structure to the upside. So now just looking at straight market structure, right, on this next day, I'd potentially want to see a pullback within this range to reaching back above higher prices, right? That was the exact bias that I made this day, right? Just keeping things very, very simple, right? And when we're anticipating a pullback within the markets, we want to identify our premium to discount levels. So if I want to be buying, I want to be buying within a discount, right? So if I anchor Fibonacci from this low to essentially this high point, I want to be buying at or below the 50% of this level, right, within a level of support. And identify this fair value gap right here on the 4 hour. Like we mentioned, this would be a good level of support, right? This first fair value gap up here on the 4 hour, this wouldn't be a good level of support, right? Because price is all the way up here in the premium, right? This would not be a good strong support zone. But we do have, seems to be this last not close candle right here, so I can mark this out as well. So we have this last not close candle right here of my order block, so I'll mark out the 50% right here. Is also in alignment with the 50% of the premium to discount zone. Main emphasis today, right, is I want to see that manipulation, right? I don't want to be buying when the market's already going higher or is already higher 100 points, right? I want to be buying when the market is conditioned to where it's created that manipulation to go lower, right? So my main emphasis is I want to be anticipating the shorts here to tap into level support to reach back above higher prices. So now that I've created my overall bias here, anticipating that pullback within the support zone to reach back above these previous day highs, now I'm going to go down to a 15 minutes time frame to see what happens next. 15 minutes time frame here, kind of just keeping things pretty simple. 10 a.m. is just about to open up. We can see that price has come back into this bearish fair value gap, right? Price has just come back into this level of resistance. So I'd probably anticipate price to come into this level of resistance to find this, liquidity that it needs to reach back below lower prices. But once the market comes down into support level, I can no longer look for shorts, right? Because price is in a overall support level, right? Why am I going to look for shorts in a support level, right? So I want to see, as we're above these highs, price to come lower. So essentially to come down into this level. And then once we're at this level, I want to see price accumulate a little bit and then see a breaker structure to the upside. When we can identify that breaker structure on the 15 minutes, then I can go down to 5 minutes to look for that pullback to reaching back above higher prices. So that's the overall strategy. That's what I'm looking for, that manipulation to create that breaker structure to the upside. Go down to 5 minutes to look for my retracement. Let's see what happens. See price open up, come lower within the 50% of that order block level. It did not tap into that 4 hour fair value gap, which is perfectly fine, right? This order block level right here is more than enough. And then we can kind of see this rejection to the upside. So around 10:15 here, as the 4 hour opened up, 4 hour opened up, create that strong spike to the downside here. And then on the 15, we can see this rejection to the upside. So after again this 15-minute rejection right here, I went down to 5 minutes time frame to look for any fair value gap, right? Which we can see here, this was my exact entry. So we can identify what we call this inversion fair value gap right here. This was once a bearish fair value gap right here, but once price tapped into this level of support, it found the support it needed to push back above higher prices. So once price comes down into fair value gap, this is now a level of support, right? Price broke above it with this strong body close. This is now a level of support. So once price comes down into this level, it should find the support it needs to reaching back above higher prices, which this was the exact setup that I took within this inversion fair value gap. Like I mentioned, my first trade is always with a wider stop loss, which was about 14 points at this time. So a 14-point stop loss, just reaching back above higher prices here. Even though I knew price was going to take out these previous day highs, this offered me more than a 2.5 R. So I simply just took the trade. Price came down into its inversion fair value gap. If we can see some type of breaker structure running away from this level, I can then scale into my position, which we can see price comes down into that inversion once again. We start seeing this push to the upside. And once we got like this breaker structure of this prior 15-minute candle, scaled into my position, adjust my stop loss back below these lower levels, targeting back above these highs. So that first trade is with lower risk, but a wider stop loss. As price goes in my favor, I maximize my overall reward, keeping my risk very small, but having that great reward. Then we can see here, price obviously reaches back above higher prices, and then we're off to races, and price eventually takes out those previous day highs. Perfect. In this video, we covered a wider range worth of topics, right? Going over the strategy, going over risk management, trade management, as well as overall psychology, how I'm able to control myself, following the same systems, same skill sets, same rules every single day, right? These are the multiple components that you need as a full-time trader to follow on a consistent daily basis to be successful over a long term, right? It's not always about having a 90, 100% win rate strategy. Sometimes it's the simplest strategies, which is proper risk management, trade management, and keeping your losses small, maximizing your winners. Those are the only thing that you need to becoming a full-time trader. The thing that you need is just a passion for trading and the discipline to become better and better every single day. And this is why me and my brother are great mentors, because we give you that discipline, we give you that motivation, as well as we show you the reality of trading through these educational videos to give you that motivation that you need to continue along your journey, right? It's gonna be tough, but it's worth it in the long term. As long as you can push through the moment of despair, all the doubts, right, you will come out the other side a lot better, right? And if you guys want to join the Spark movement, which we're helping every single one of our students help make their first $10,000 trading through day live trading, education, as well as mentorship throughout this entire year, click that first in the description and join the Spark Trade mentorship. Before you leave, make sure you guys click that like button, subscribe if you're new to my channel, as well as comment what you guys want to see next. I'm your mentor, Arkhamtrades. Be safe.